This is a bond, contractual right to receive cash or a financial asset of another company. And D is a contract that will or may be settled in an entity's own equity instrument. This is an option, for example, an option. An option is the right to buy something, right to buy a stock, for example. Right, you can buy the right to buy a stock. Sounds funny, but it's possible. You buy the right to buy a stock. This is called a buy option. You can also buy a sell option. With a sell option, you buy the right to sell a stock at a certain price. So when we talk about investments, we have key terms. We have to define key terms. There is an investor, and an investor is an entity that owns the shares of a corporation. So, for example, Amazon has bought Whole Foods. Maybe you know Amazon. Probably you know Amazon. Maybe you also know Whole Foods. It's a healthy supermarket, kind of like. Here Amazon is the investor. Amazon is the investor. Amazon is the investor. And Whole Foods is the investee. But you can also be an investor. If you buy shares, you are an investor. If you buy shares, you are an investor. Berkshire Hathaway is also a big investor. Maybe you have heard about Berkshire Hathaway. Does anybody of you have heard about Berkshire Hathaway? What is Berkshire Hathaway? What is Berkshire Hathaway? Berkshire Hathaway is a holding company. Holding company means it owns several other companies and other stocks, other minority holdings. And Berkshire Hathaway, the CEO of Berkshire Hathaway is Warren Buffett. Maybe you've heard about Warren Buffett. Warren Buffett. And so these are the majority holdings of Berkshire Hathaway. Majority holdings means Berkshire Hathaway owns more than 50% of those holdings. And that means essentially if one company owns 50% of another company, or more than 50%, then Berkshire Hathaway can control this company, these companies. So this is control. And how do they appear on Berkshire Hathaway's balance sheet? If Berkshire Hathaway owns more than 50%, then they are consolidated, these companies. Consolidated means that all assets appear on the balance sheet, essentially, of Berkshire Hathaway, and also the liabilities. So it looks like on the balance sheet, on the consolidated balance sheet, it looks like Berkshire Hathaway and these firms are essentially one entity. Yeah. So these were majority positions, more than 50%. Here, these are minority positions. Minority positions means this is less than, in this case, it's less than 20%. Yeah, so this is less than 20%. So they, with these companies, for example, Berkshire Hathaway has no control over them. Yeah, Berkshire Hathaway cannot control them. They cannot say to these to the management of these companies what to do. Yeah. So, and therefore the accounting treatment is also different. Yeah. They appear on the balance sheet of Berkshire Hathaway on a mark-to-market basis. Yeah. So here the market value goes into the balance sheet of Berkshire Hathaway. And here, when we have Coca-Cola, for example, Berkshire Hathaway owns a piece of Coca-Cola. Yeah, so maybe 5 to 10%, I don't know exactly. But when the price of Coca-Cola, when the market price, the stock price of Coca-Cola rises in value, then the balance sheet of Berkshire Hathaway also increases. Yeah. So the daily fluctuations of the market actually influence the market, the balance sheet values. Yeah. So that means that the balance sheet actually becomes very volatile. Yeah. It changes a lot. Yeah. But this is only for position sizes of less than 20%. Yeah. So if you own less than 20%, and you have to put the stock price on the stock on the balance sheet. Yeah. And your balance sheet becomes very volatile. Yeah. And it's very similar than consolidation. Yeah. What we talked before, when Berkshire Hathaway owns more than 50% of the shares of a company, then essentially the subsidiary, which is the investee, appears to be part of the consolidated balance sheet. So it looks like Berkshire Hathaway owns the whole company. It's essentially one entity. Yeah. But here, this is if Berkshire Hathaway only owns, let's say, 5 to 12% or something like that of a company, then you do not see the entire balance sheet of Coca-Cola on the balance sheet on the combined balance sheet. Yeah, but rather you see the stock price fluctuations, and when Coca-Cola goes up in value, the stock price, then the balance sheet of the asset value on Berkshire's balance sheet goes up. Yeah. When we're talking about investments, there is also difference between short-term investment and long-term investment. Short-term investments is less than 12 months. Long-term investments is more than 12 months. more than 12 months. And what counts is what you expect. When you buy a stock, for example, and you buy a stock, you let's say you expect to hold the stock for 8 months. Yeah, then it's a short-term investment. Yeah, even when it turns out that you hold it for longer, it is qualified as a short-term investment. Yeah, because what counts is what you expect in the at the time when you buy the thing. Are there any questions so far? No? Okay. So then we go on. So very generally, this table shows 3 categories of investments. Yeah, and the first category is financial assets. First category is financial assets. The second category is investments in associates, also called equity method investments. And the second is investment in subsidiaries. Yeah, and it is based on the table is based, or the subcategories are based on the ownership stake. Yeah, how large the ownership stake is. With financial assets, the ownership stake is less than 20%. With equity method investments, the ownership stake is between 20 and 50%. And with subsidiaries, investment in subsidiaries, it's typically more than 50%. Yeah? So here you have a controlled position. Yeah. This, if you own only 20% or less than 20% of a financial instrument, then there are essentially three subcategories here for this column here. First is amortized costs. The second is fair value through other comprehensive income, and the third is fair value through profit and loss. And we will come to these subcategories soon in more detail. Yeah, but this category, financial assets, yeah, if you own less than 20% of something, is mostly it's short term. Yeah, if you think about, you own a stock, and if you own a stock, you typically own less than 20%. Then it's mostly short term. It's of course it could also be long term. For example, Warren Buffett is known to be a long term investor, but nevertheless, there are a lot of people who trade with stocks, go in and out of the stock market. When you have larger ownership positions, then these are typically long-term investments. Yeah. Even with an ownership position between 20 and 50%. Yeah. So the middle category here, you typically have a long-term position. Yeah. Yeah. So if one company owns 30% of another company, typically it doesn't trade in and out of the stock. It doesn't really make sense, because it's not that easy to buy such a huge chunk of a company, essentially. Yeah. So if you own between 20 and 50%, you cannot control the company. You cannot say, okay, we hire a new CEO, or we fire the old CEO. But at least you can exert significant influence Yeah, you can exert significant influence. What does that mean? You exert significant influence. That actually that means or maybe we have one board member. Yeah, you send one board member, and then at least you have a say. You can say, okay, we want to change our financial policy, or we want to change our dividend policy, or something like that. Yeah, but you cannot control. You do not have full control over the company here. Yeah, this is the right category. If you own more than 50%, then you can exercise control. And exercising control really means yeah, you are the boss. Yeah, you are the boss. Then here, this is called the investor in a subsidiary is called the parent company. Yeah, it's called the parent company, and you really can change how the company is doing things. Are there any questions related to this table? We will talk about how, depending on which category you choose, how the treatment, the accounting treatment, differs. But so far, do you understand what? Yeah. No questions? Okay. If you have any questions, you can always ask. Yeah. Don't hesitate. Referring to financial instruments, we have financial assets. We have a new standard, a relatively new standard, which is called IFRS 9. It's effective from 2018, and before there were a different standard, but now you have to use it, and so the standard essentially says that a financial asset should be recognized when the firm becomes party to contractual provisions of the asset. So actually, it means you focus on the contract, yeah, and not so much about on future economic benefits, not so much on future economic benefits. And when we're talking about derecognition, when you want to get rid of the or when you get rid of the asset on the balance sheet, this is when the contractual rights to the cash flows of an asset expire. Yeah, when the contractual you do recognize the financial assets when the contractual rights to the cash flow of an asset expire. What does that mean, the contractual rights to the cash flows of an asset expire? What does it mean when the contractual rights to the cash flow of an asset expire? Essentially, it means that the maturity date is reached. Maturity date is reached. Yeah, then the of a bond, when the maturity date is reached, then the contractual right to the cash flows, to the coupons, have expired. Yeah. So when the contractual rights to the cash flows of the asset expire, then you have to derecognize the financial asset, or you also have to derecognize the financial asset when the entity transfers the financial assets. So essentially, that means it sells the financial assets, or the risk and rewards that are related to that asset. Yeah, then you can and should derecognize the financial asset. The classification, which category to choose of the subcategories here, depends on the business model and on the contractual cash flow characteristics of the financial asset. So what is the business model when we're talking about a financial asset? You can either hold the asset in order to receive the cash flow. Yeah. Business model could be hold the asset in order to receive the cash flow, or sell the asset. Yeah, both is possible. You can hold the asset. Maybe with a bond, it's more likely that you tend to hold the asset with a bond. With a stock, it's maybe more likely that you intend to sell it, to trade it. Yeah, so this is at least what most people think about when they think about a stock. They think about trading. When they think about the bond, it's more likely that they hold the bond until the maturity date is reached. Yeah. And it also depends on the contractual cash flow characteristics. So contractual cash flow characteristics means actually what kind of cash flows does an asset have? Yeah. So for example, in the case of a bond, how do the cash flows of a bond look like? You have every year or twice a year, depending on which country you are. You have coupons that you get paid. This is the interest payments you get with the bond. So every year you get interest payments, and at the end you get a lump sum when the maturity date is reached. Yeah. So this is a cash flow characteristic of a bond. With a stock, it's different. Yeah. With a stock, you do not get interest payment. You do not get coupons. What do you get when you are an investor in a stock? What do you get? Do you also get money? What do you get in a stock? Yeah, you get You get, yes, Liang, this is correct. You get money, but how is it called? How is it called? Is it called what you? How is it called what you get? If you're an investor in the stock, how is it called? It's called a dividend. It's called a dividend. Yeah, and the dividend is not fixed. Yeah, the coupon is here. The coupons are fixed. Yeah, they are fixed in a bond. Yeah, but in a this is a bond. Yeah, so bond. But in a stock, the coupons are the dividends are not fixed. Yeah, they change depending on what the business is doing. If it's doing good, they are rising, and if the business are not doing good, like now in the Corona crisis, for example, then the dividends are cut. Yeah, so the cash flow characteristics are different in a stock than in a bond. When we're talking about financial assets, we have, as I said, we have 3 different subcategories. The first is amortized cost. Amortized cost is the first category, and then we have essentially two fair value categories. So this is fair value through profit and loss, and fair value through other comprehensive income. Yeah, and the measurement, how you measure it, depends on the classification, depends on which category you choose. Yeah, so a fair value essentially means that these here, fair value through profit and loss, and fair value through other comprehensive income. Fair value means that both are measured with market value. Yeah, and yeah, amortized cost is not market value. Here, you initially you record it with costs, and then you amortize it over the lifetime of the instrument. Yeah, mostly it's a bond here, and you choose amortized cost. We will come to that now. So amortized cost, this is the first subcategory. This is the first category, and here you measure it at cost. Yeah, so initially you measure it at cost. So let's say this is the cost. This is cost of an asset. Yeah, so this is the time, and this is the value. Let's say value in euro. So, and then over time, it's not relevant what the market value is of this instrument, but rather you amortize it. Yeah, you amortize it over the life of the bond. Essentially, what you do is you use and you spread the interest expense over the life of a bond. It's very similar than with the depreciation. There you also spread the costs over the life of the asset. And here with a bond, you spread the interest expense over the life of the bond. The business model here is you hold to collect the cash flow. You hold the bond to collect the. I say to hold the bond, but actually, it is a bond. So you are not you're not allowed to put a stock in this category. Why? Because the standard says amortized cost means that your cash flow characteristic is principal and interest on specified days. Yeah, so the principal and interest on specified days. And if you think about a stock, can it be a stock? Does a stock have principal and interest on specified days? Does a stock pay interest? Does a stock pay interest? Think about it. No, it doesn't. It doesn't. It pays a dividend, and that's why the stock is not suitable for this category. Yeah, you cannot put a stock in this category, and that's why only debt instruments and loans are suitable for this category. Yeah. So stock doesn't pay a dividend. Yeah, though that's why only debt instruments, loans can be put in this category, because the cash flow characteristic is principal and interest on specified days. So this is the next category, fair values rather comprehensive income. Here stocks can be put in that category if they are not held for trading. If they are held for trading, then you should opt for the next category. We talk about later, if in the next slide actually. So then you should opt for the fair value through profit and loss. If it's for trading. But if a stock is not held for trading, but rather for it's held to own it rather than to sell it, then this category is the right category. So stocks can be put in this category, but it's also suitable for debt instruments. Debt instruments are bonds. Yeah, debt instruments are bonds. If not only for collecting the cash flows. Yeah, so if you're holding a bond and you think about, okay, eventually I might sell this bond, then you can also opt for this category. Yeah. Fair value essentially means the market price. Yeah, you take the market price from the stock exchange or the bond exchange and put it on the balance sheet. Yeah, and here in this category, gains and losses are recognized in OCI. Gains and losses are recognized in other comprehensive income. Yeah. So it's fair value on the balance sheet. Fair value on the balance sheet. Every balance sheet date, you think about what is the fair value, and you take the fair value. So this can be quite volatile. Yeah, when the stock goes up, then the asset value goes up. When the stock goes down, then the asset value goes up. So it can fluctuate quite a lot, because you do not have amortized costs, but rather you have the fair market value on your balance sheet. Yeah. So, but what is not volatile is your income statement, because if gains and losses are recognized in other comprehensive income, yeah, and other comprehensive income is not the income statement, is not earnings per share. Yeah, analysts focus on earnings per share, investors focus on earnings per share, but this is other comprehensive income. Yeah, so the rule says if you put a stock or a bond in this category, fair value through other comprehensive income, then the changes, they are shown on the balance sheet, but they are not shown in the income statement. They are shown in other comprehensive income. Yeah. And this essentially is the last category. This is the last category, fair value through profit and loss. Yeah. So here we also have fair value, but the fair value on the balance sheet. So balance sheet, fair value on the balance sheet. But in addition to it, we also have it in the income statement. So the swings of the market actually influence our income statement. So in addition to the balance sheet, here also our income statement becomes quite volatile. So the gains and the losses of a stock are recognized entirely in the income statement. Yeah, even if they are not realized, even if you do not sell the stock or buy the stock, then those gains and losses are recognized in the income statement. Yeah. So here we really talk about stocks, or we really talk about stocks or derivatives. Yeah. Bonds and loans are not allowed to put in this category. Yeah. Yeah. It's stocks, and derivatives. Yeah. Okay. I would say let's have a break, 15 minutes. Okay, so let's go on. So generally, these are the three categories here. Yeah. So these are the three categories, and amortized cost is for bonds. Yeah, amortized cost is not for stocks. Yeah. Fair value through profit and loss. This is for stocks. For stocks and derivatives. Stocks and derivatives. And fair value through other comprehensive income. This is kind of like for bonds and for stocks. Yeah, for bonds, if you do not only intend to hold it, but also say, okay, you might sell it. And for stocks, if it is not for trading, so it's like it's an in-between category here. Yeah, so this is like a mix, and here you also have your fair value. Yeah, but here the fair value is only applied to the balance sheet, but not to the income statement. Here the fair value relates to both the balance sheet, so the balance sheet fluctuates a lot. Yeah, the market prices influence the balance sheet, but also the income statement. So balance sheet, this is balance sheet, fair value is balance sheet and income statement. Income statement. Yeah. Here, the fair value only relates to the balance sheet, and not to net income. Only other comprehensive income. Remember, other comprehensive income is the income that is not the core business. It's not that important, as Standard Setter says. Yeah. So, and amortized cost is no fair value at all. So if you have amortized costs, the balance sheet and also the income statement is not volatile at all. Yeah. Are there questions related to these categories? Are there questions related to this financial assets? Do you have questions? Feel free to ask them. Did you understand it? Is it clear? Yeah, okay. Yeah, so the subsequent measurement really depends on which category you choose. Yeah, and this amortized cost is much smoother. Yeah, that's much smoother. The fair value, the changes in value in the market value, they go into the balance sheet. Yeah, and if you opt for fair value through profit and loss, then it even goes into the profit and loss statement, the income statement. Okay, so we have exercises here. So now it's your turn. Yeah, Shack Corporation purchased a fair value through other comprehensive income investment in 1,500 shares of Home Central for 24 shares. On the next balance sheet date, Home Central shares are quoted at 27 euro per share. Shack balance sheet should report realized gain of 4,500, investments of 40,500, unrealized loss of 4,500, or investment of 36,000. Think about it. Think about it for 5 minutes and then tell me your answer. Do you already have an answer? No? Think about it. First, try to do this on your own. I give you 5 more minutes, and then you can tell me the answer. Okay, what is your answer? What do you think makes sense? What doesn't make sense? Can you rule out something? Or is it too difficult? What's the problem here? If it's too difficult, it's okay, but I have to know. Could it be a realized gain? Could it be a realized gain? What does realized gain mean? What does realized gain mean? What does realized mean? What does realized mean? Could it be a? Can you rule out an answer? It couldn't. A is not possible. Why is A not possible? Because it doesn't say anything about that the stocks are sold. The shares are quoted at 27. So they are not sold. So it cannot be realized. Yeah. So we can rule out A. What about C? What can you tell me about C? Can C be true? Can it be a loss? Can it be a loss? No, because it has appreciated. Has appreciated in price. So we can rule out C. Yeah. So is it B or D? What would you, how would you calculate it? So let's see. Is this fair value through other comprehensive income? So we have to take the fair value, which is 27 times 1,500. And the answer is 40,000, 40,000, 40,000, 40,500. Use the data from the last exercise. Assume a tax rate of 20%. Jacques should report unrealized loss of 4,500 in the income statement, realized gain of 4,500 in the other comprehensive income, unrealized gain of 4,500 in other comprehensive income, and unrealized gain of 3,000 or unrealized gain of 3,600 in other comprehensive income. Think about it. At least you should be able to rule out something. You can definitely rule out two answers. So think about it. Which can you rule out? What can you rule out? So think about it. Can it be A? Can it be a loss? No, it cannot. It cannot. Because it has appreciated in price. Yeah, it has appreciated in price. It has increased. So can it be B? What about B? What about B? Can it be a realized gain? What does realized mean? Sold, yeah. So has it be sold? Has the stock been sold? No. So B, it cannot be B. So it's only C or D left. And here we assume a tax rate of 20%. Yeah. And the original value was 24 times 1,500. This is the original value. And the current value is 27 times 1,500. So the original value was 36,000. The current value is 40,000. 40,500. The question now says that we have a tax rate of 20%. So this tax rate does not have to be paid now, but it's a deferred tax. It's called deferred tax, and this is a liability because later, when you sell the stock, deferred tax, when you sell the stock, you have to pay it eventually. Is 20% times the gain, the difference. The difference is 4,500. Yeah, so this is the difference. 20% times 4,500 times, sorry, 4,500, and this equals 900. Yeah, this equals 900. So in other comprehensive income, there is an unrealized gain of 3,600. Why? Because this is 4,500 minus the deferred taxes. Yeah, so this deferred taxes is a liability that you eventually have to pay. Yeah, so that's why, because of this deferred tax liability, your unrealized gain is only 3,600. Yeah. Does it make sense to you? Do you understand? Are there questions? Okay, good. Then we go on with, actually, this is the second category. Yeah. So if you look back, the second category, which is equivalent to an ownership position between 20 and 50%, is called investments in associates. Investments in associates equals an ownership position between 20 and 50%. There, often you have one board member from the investor. Yeah, maybe the CEO or the chairman. Yeah, maybe the CEO or the chairman, and you can influence the operating and financial policy, the operating and financial policy, but you cannot control it. Yeah, but you can affect the dividend policy, product line, etc., etc. Yeah. So, for example, in the case of Berkshire Hathaway, yeah, you know, maybe Berkshire Hathaway. Berkshire Hathaway owns 20 something percent of Kraft Heinz. Yeah, so it's the largest investor, Berkshire Hathaway, but it cannot control it. Yeah, so that's why it only has significant influence, and it has to use the equity method. Equity method is another word for investments in associates. Yeah, there's one exception, and the exception is when a firm or an ownership position is held by a venture capital firm, then we have to use fair value through profit and loss. So how does the equity method work? Initially, the investment is recorded at cost. Yeah, so this is nothing new. If you buy something for, let's say, 200 million, then you put it on the balance sheet for 200 million. Yeah, this is the same for any other asset also. Yeah, but thereafter you adjust the value for the change in investors' share of net assets of the investee. Net assets, excuse me, net assets equal equity. Yeah, net assets equals equity. Yeah, so you adjust, the investor adjusts for the change in the investor's share of the equity of the investee. Yeah, when the equity goes up, then the equity method says that the asset value on investor's balance sheet goes also up. Yeah. And in the income statement, the profit of the investor includes the share of the profit of the investee. Yeah. So this is the balance sheet here. This is the balance sheet. You adjust for the change in the investor's share of the investee. And this is the income statement. the equity earnings appear on the investor's income statement. Yeah, so on the income statement, you see something. You see the equity earnings. Often it's listed under financial income. Listed under financial income. Financial income. Financial income. And it's often labeled as share of profits of the associates. Yeah, sometimes it's also called income from equity affiliates. Yeah, but of course, if the associate, the equity investment, has a loss, then it also leads to a reduction in the income of the investor. Yeah, and a reduction in the net assets of the investments in the associates. Yeah, so this is the equity method. Yeah, generally, whenever the equity changes of the investee, then you show that on the balance sheet of the investor. Yeah. Okay. Are there any questions? Are there any questions? Are there any questions so far? No questions? No questions? No. Okay. Then I would suggest we stop here, because the next we go on with the next section next week. See you next time on Monday. See you on Monday at 9. I think it's 9 a.m. German time. See you. Bye bye. Bye bye. Bye bye.